get started here, thank you very much for joining us on the multifamily side. A couple of things that I mentioned earlier, there are some interesting things happening in the multifamily world. As far as investment class, there's a lot of legislation against it. There's a lot of new due diligence requirements related to it. I know both AJ, Lindsay, and Gina are seeing some interesting projects coming across their desk for refinance, so we'll be able to hit them up with that. But why don't we do some really quick introductions of our speakers and those that will be asked to speak. So AJ, you're showing up on my screen as the speaker. So go ahead and tee us off with a quick introduction on yourself, and then we'll go from there.
Perfect. AJ Bellino, Regions Real Estate Capital Markets. I am a Fannie Mae, Freddie Mac lender, both small and large balance, do deals across the country, and have been at this for just shy of 25 years. So if there's a landmine to step on, odds are I have. In any case, AJ Bellino, Regions Real Estate Capital Markets.
Beautiful. Lindsay Spute.
Hi, I'm Lindsay Spute, and I'm a loan production officer with Everbank, and we specialize in multifamily lending. We have a new program that we've launched to the market with several benefits. We're able to offer competitive rates, low costs, and a transparent and streamlined process. We focus on multifamily properties in the major metro markets of California, Florida, Portland, and Seattle, and are able to accommodate purchase, refi, and cash out refinance requests. The loan amounts are geared to loans between 1 and 20 to 25 million. So look forward to getting to know all of you today.
Beautiful. Thank you, Lindsay. Gina Conan.
Yeah, hi, Gina Conan with Provident Bank. We're a big small bank, let's put it that way. We're actually a brick and mortar bank. We have about 17 branches in Southern California. And I work for the commercial loan division, where we focus heavily on just, multifamily, some office, some mixed use. We don't require deposits for our loans. In fact, we don't mind either way. Our loan sizes are about 300,000 on up to about 4 or 5 million. So we're kind of that small balance lender. What else can I say? I've been with Provident Bank going on 18 years this year. We've been around for about 65 years. So we know what we're doing. Local decisions are made. We work well with brokers. And there we go.
Fantastic. Thank you, Gina. RC, I'm going to end with you on the introductions, and then I'm going to ask you our first question. So.
Okay, well, bear with me. I'm having a little bit of technical difficulties. I had to move over to my phone, but we go. RC Propster, Partner Engineering and Science. I'm one of the founding partners. We do phase ones, property conditions, seismic, balcony retrofits, as well as appraisals now, and zoning, full force of A to Z due diligence. So we can help you out. We do a lot of multifamily for agency. I specialize in agency actually, and bank loans as well. So yeah, we're here for all your due diligence.
Perfect. So I'm going to start you off with our first question too, and then I'm going to open it up for the audience to see if there's anything that you want us to make sure that we cover in the time that we have. But RC, I know we mentioned the balcony, typical due diligence. I'm looking at the physical property. I'm trying to figure things out, but there's some new laws or some new legislation that's come out that is going to be expensive and impactful. So if you wouldn't mind just covering a little bit about what that is.
Sure. So SB 721, all apartments 3 units or over need to have their balconies inspections. It's due by January 2025. And we don't know how they're going to implement if it gets done or not, but we're thinking there's going to be some kind of fine or some kind of penalty. We're still unsure of that, but you do need to get balconies with any overhang. Need to be inspections for balcony, and it can be costly. And right now there's a very large wait list to get that done because everyone has waited last minute. So but once you get started, you get the permitting in and you show that you've already started the process. It's okay if you go past 2025 as long as you've gotten started on getting the inspections done.
Right, and the purpose behind it is seismic, correct? So
Yeah.
they're just
Yeah.
making sure it won't collapse, or during an earthquake, it's safe. So
Yeah.
you're talking about a seismic retrofit to these buildings.
Yeah, a seismic retrofit for the balconies, aside from the implemented seismic retrofit for your carports, if you have overhang carports, or like, some people see the little sticks to the building and you have to park underneath. That's been a big issue, and I'm sure AJ can attest to that on agency loans, because you do have to get a seismic report. So those have to qualify as well.
I love me a good segue. So AJ, let's talk about what you're seeing either in relation to some of that, or what you're seeing as far as submittals, and where are rates these days for what you are producing.
Outstanding. Well, first things first, I will definitely dovetail off of what RC had spoken about with balconies. So this is a big issue, and it is mirroring, at least in rollout, what soft story remediation was like in San Francisco and Oakland. So as far as mandated seismic retrofit, it is very, very much like that. You had a lot of sponsors who are really terrified about having to come out of pocket to get this work done, or some lenders saying they're not going to finance their assets until the work is done. It's really kind of a mixed bag. It's like trick-or-treating in a bad neighborhood. You just don't know what you're going to get. So with agencies, this is pretty simple stuff. If you have a balcony retrofit and you've got to get it done, you can still get an agency loan done. What will happen is you're going to be given about 12 months to get your work completed. The big trick, and this is where things are a little bit dicey, people like RC are absolutely hustling to get these inspections done. There is a backlog. So my advice to you, if you have to get the work done, definitely get started as soon as you can. Don't think that it will preclude you from getting a loan, but understand that if you do, you will be subject to a holdback, and that holdback is going to be about 125% of the cost of the work. So go out, get the work done. If you need to take a little cash out to cover the shortfall to actually fund your project, you'll have whatever was held back released to you upon proof that the work was completed. Usually that's inspection by your permitting authority that'll rubber stamp kind of what's happened. So there's no need to panic, but there is need to plan and take immediate action. So that's number one. Number two, where rates are these days. And I know that that's what most of you guys tuned in for. I've quoted about 16 deals in the last week. And my quote ranges, there's going to be a little sticker shock here. The lowest rate that I quoted in the last week was 535. The highest rate that I've quoted in the last week was 6.5. The delta between those two has everything to do with the market in which you're located, the leverage point of your loan, and whether or not your rates or your rents have affordability in them. That's a calculation that I can make pretty quickly. But generally speaking, if your rents are at or below market, which is approximately 80% of AMI, you can get 30 to 40 basis points off your rate. So you have the opportunity to go into a refinance and get yourself a nice middle five handle at par if the stars align. Your worst case scenario is probably going to be about 625 to 645 in the event that you're fully leveraged and there's absolutely no room for affordability at all in your rents, or you happen to be in a small or rural market where you're looking for some kind of a compressed prepayment or a little bit of prepayment flexibility. Those are the kinds of things that will drive your coupon up. As far as what I'm seeing, lots and lots and lots of maturity refinances. There aren't a lot of elective refis these days. I've been getting lots of inquiries into acquisition financing, but most assets that are for sale for a reason. And so I'm finding that much of what it is that comes across my desk On the acquisition side, it is penciling at or around 50 to 55% leverage. Folks who are just getting into the market right now are usually wanting to get in at somewhere around the 70% range. And so there's still a little bit of a disconnect in what I'm seeing from sellers and the pool of buyers.
Fantastic. Lindsay, why don't we step to you next? What are you seeing these days? Where are you these days? What are your rates these days?
Yeah, so on the rate side, our programs are priced off the CMT rates, which have been trending downward. So we've been pushing our floors a little bit on that side, maybe 10 to 15 bips based, kind of case by case based on the deal. So, probably best case, between 635 and 650 on a 5-year. So a little bit on the higher side compared to AJ's rates. And then a little higher than that on the 3-year fix. There's a little bit of a premium for the 3-year program. As far as what we're seeing, very similar, lower leverage requests on the purchase side, requiring more down payments. On the refi side, very similar. It's not a lot of refis by choice, deals that maybe have been repositioned, deals that are maturing, deals that are coming out of new construction takeout. And a theme that I've been seeing too is, which is unusual for us to see, is almost the choice between borrowers looking at selling the property or refinancing the property. So some of the properties that we're looking at might actually be listed as we're looking at it for a refinance, or I've had deals that I'm looking at as a refinance and get a call, they're looking at maybe selling it. So borrowers kind of checking out their options on both sides.
Perfect. So, Gene, I'm going to come back to you in a sec. AJ, take yourself off mute. So I'm going to say, are you seeing more submittals or less submittals in comparison to last year? And do you anticipate seeing more submittals or less submittals for the rest of the year? So, Lindsay, I'm going to let you answer first because you're right here. More submittals or less?
I'd say things are picking up the last couple of weeks as well, with the rates kind of dipping down, offer some opportunity for people. A lot of the deals that I'm even looking at now might have been deals I looked at a couple months ago. People aren't, there's no pressure to move quickly, or at least there has not been. So a lot of people who have refi opportunities are kind of waiting to see what happens with rates. So almost re-looking at deals that I might have looked at previously.
Perfect. AJ?
More. And the driver really is maturity. You have a lot of maturities that, the maturities we were talking about last year are coming to the fore. Lenders are much less likely to extend. And so at the end of the day, you've got sponsors who may just not have a choice. And the cash in that was optional last year is becoming mandatory this year. So I would say more. And I would say that as we progress on into the year, you're likely to see more submissions. Not more acquisitions, but definitely more refinances.
Perfect. All right, so Gina, to you, you have the 10 questions I posed to everybody else and the ones I've tabbed on.
Well, I have to mirror both what Lindsay and AJ are saying. If you think about it, well, at least the majority of multifamily loans tend to be on a 5-year fixed. And the last time they would have purchased or refinanced right now would be 2019. 2019 rates were 3.5, 3 3/4 maybe. And now what's happening is their fixed period is ending and they're rolling into, we follow the 1-year CMT plus a margin of 3% or 3.5%. That's putting their rates now on the rollout to 8.5 or 9%. And from 3% to 8.5 or 9%, that's almost triple your mortgage payments. Yeah, exactly. And what I'm finding daily is, a lot of people are coming back, say, whoa, my rate's 9%. I don't, they always say, I don't remember signing for that. I'm like, well, of course, because, nobody knows what the index is going to be when you're signing in 5 years, when you have 5 years. So a lot of educating, but like Lindsay said, oddly enough, I'm busier now than I was in January for sure. This time last year, I think because rates were really starting to incline, people were sitting on the fence going, nah, I'll wait a couple months. So I don't know why, except for people are just digesting this is where rates are. And like AJ said, they're rolling off and they've got to do something. It's better to get the high 6s or the low 7s instead of the 9 that they've rolled into now. So I always try to wake up and go, okay, why am I busy and why am I not, bigger than just, oh, look at me, I'm cool. It's not that, it's the market.
No, you're
Right.
cool.
That's
So
funny.
let me kind of make this point and then see if you agree or disagree. But in 2019, my loan was at 3%, but my rents were at $1,000 a month.
Sure.
Now I'm in 2024, my interest rate may be 5 to 9, but my rent's $2,000 a month. Are you seeing, because it's 2019 to now, that I'm not going to suffer as much, or I'm not feeling the pain as much because my rents at least might be higher, so I'm getting a higher value that I'm getting my loan to value on? Or am I just wishful thinking? Go ahead, Gina.
Well, no, I think, it's all relative because most of us, and I don't want to speak for everybody, but I think Lindsay and I both work on debt coverage ratio. We're looking for a minimum. Lindsay, is your DCR 1.25 or 1.2?
1.2 on cash out refis, and we could do a 1.15 on purchases.
Oh, you've come down. Okay. So we're still 1.25 to 1.2. And that's why, like Lindsay and I are in competition, but there's also things that she can do that I can't do and vice versa. But anyway, back to my point, if your rents have gone up and then you're working with a lender with, a good debt coverage ratio that helps, that's fabulous. But unfortunately, a lot of these people are trying to keep the tenants that they have. It depends on the market they're in, because if you're up in Chico or you're out in Barstow, you can't get higher rents. Maybe market rents have gone up, but you can't find the tenants that are willing to pay, let alone getting your own tenants to continue to pay, because the world's shifting. So there's too many variables for me to say, yeah, that was an easy scenario, you'll be fine.
Got it. And I see AJ nodding, but I'm going to go to Lindsay first to dovetail that. Then I'm going to get AJ.
I was going to say it depends. There's two scenarios, and it was probably a couple months ago. I met with a brokerage group that I do some business with, and we were talking about some of the deals they had, and they kind of had two scenarios. One was a deal that we had done, a couple of years ago. They were maybe looking to refi. I said, "How does it cash flow?" Oh, they've been pushing rents and maybe repositioning units as they turn. It should be fine. The other one was a deal that the client had put, maybe some 3-year money, had plans, to add in, maybe an ADU or two, and had these plans and wanted the shorter term fixed program. Well, unfortunately, the 3 years went by and those plans were never executed. So like that's the person who's going to find themselves in a problem. Yeah.
All right, AJ. I saw you nodding and saying, ready to go. Hit me.
Yep. Well, so my most aggressive debt service coverage ratio is 120. And let me just give you, for instance, here, and folks who invest are going to understand this. So your rent's worth $1,000. Now let's just be conservative and say they're $1,750. That's outstanding because your NOI is increased. However, the metric against which I am going to constrain your loan, that's gone up a little bit too. Your qualifying interest rate when you bought your asset in 2017, 2016, 2018, 2019 was in the 3s or 4s. Now your cost of capital and literally what's going to constrain you on a debt service coverage basis, your debt service has gone up. So what you're going to gain from a pop in NOI is going to be less significant. So if you're thinking about that 3.5% exit rate, and there are a lot of folks who get that stuck in their head, or who were thinking about valuation is another challenge that I face. There are a lot of people who are still stuck on their book value from 2018. I do a lot of business in San Francisco and Oakland and LA and San Diego. San Francisco is a 3-cap market. That just was what it was in 2018. It's not a 3-cap market anymore. And I'm sure that you can attest to this. There's 5 and 5.5 cap valuations coming out of San Francisco right now. So I have sponsors who have a book value in their head of, hey man, my asset's worth 17 million bucks. Then I get it appraised and I come back to them with 12.5 or 13 and change. And they look at me like I'm insane. And that shift it's a little bit tricky. We've had a decade or 10, 12 years of continuous economic growth. And you have a generation of investors that were taught values never go down, rents never go down. There is no such thing as vacancy because I'm in the multifamily world. And the fact is that, the pandemic kind of turned that on its head. And
Yeah.
so right now, I mean, this literally is just the fallout of that. But, at the end of the day, I'm seeing challenges in the valuation side and the debt service coverage side for sure.
Perfect. So stay there. I'm gonna hit you up, all three of you, with a quick question. Then RC, I'm coming your way, I promise. How many, if any, Fed cuts are we gonna see before the year is out? 0, 1, 2, or do you think we're going to raise? So your answer is raise, 0, 1, 2, 3, 4, 5, 12, whatever it wants to be. So AJ, you were just chatting. So Fed rate, what are we doing?
Uno, solamente uno. And it's going to hit around Turkey
Election
Day.
time.
Would be my guess. Yeah. Sometime in November. That's when we're going to get it.
Okay. Lindsay.
Maybe 0 to 1. I feel
A half.
potentially, I guess maybe 1. I think the sentiment going into this year was people were overly optimistic about what they were going to see from the Fed, and what we've seen is that the Fed's more concerned that they're going to, lower rates too soon than they are with keeping them high too long. So it'll be interesting, and we see the swings in the markets as as the headlines come out and as news of reports, whether it's inflation or the labor market. So it'll be interesting to see, but maybe best case 1.
Yeah. I like the sentence you said where they're more worried about raising too soon than keeping it up too high too long. That's a good statement. Gina.
Yeah, I mirror what Lindsay's saying, and AJ for that matter. We're just, I don't know. The rumors started the beginning of the year, and the borrowers hear what they want to hear, and they call in. I heard we're dropping. I'm going to wait till July because it's going to go down 2 points. No. So I agree. Well said, Lindsay. It's just I don't
So
know
I
that
can't
it's
hold
going
my breath.
to. Yeah, other than a chess move for politics and election, but otherwise, no, not really.
RC, let's have you answer that question. What do you think?
Well, I'm seeing a pickup, because I see it from all aspects, right? I see multifamily, industrial, commercial, everything. But on my multifamily side, I'm definitely bidding a lot more. But what I'm hearing from my lenders, I don't know, on the rate side, but from my lenders, I am putting out a lot of bids. And what they're saying is that they're sizing a lot of deals, but not all of them are going forward, right? But in the last month, I could say business has definitely gone up on multifamily, especially my agency work is going up. So is it going to get better? I mean, I'm hoping so. I'm optimistic, I think things are heading in a better direction right now.
Okay.
Then
So are we gonna get a Fed? Are we gonna get a Fed cut? Are we gonna get a Fed stay the same? What's your bet? I just want to see if I'm consistent here across the board. I want to see if I can have unanimity.
I don't think that we're going to get a break at all.
All right. So we've got zeros, we got a 0.5, and we got a 1 and a 1 for an election. Perfect. All right. So RC, let's talk about what's going on. Where are you seeing things from your world? I know your guys are frantically busy. Appraisers tough, lots of property management or property assessments going on. What's your world looking like?
Sure. So I think where we're picking up a lot of business is, when you don't get work on one street, you go work on another, right? So where we're not getting maybe the due diligence for multifamily or even our other types of commercial real estate, we're picking up on EV charging. I think right now a lot of owners are doing value adds to their property while they can, so that hopefully when they can, get things going, they can raise rents because they've put more value into their properties. I'm doing a lot of solar, not necessarily on multifamily, but in, industrial for sure. Am I seeing things pick up? Or
What do you mean by EV? What's the impetus behind that? Because the tenants are requiring it, or because they're trying to get mitigation for carbon? What's the driver on the EV stuff? What do you mean?
Because it's being required, especially for industrial. The WARE program is requiring it. So again, nothing to do with multifamily. I'm just letting you know where I'm busy on my side. For the multifamily, we're just in the same place we've been, except like I said, we've been picking up business. Loans are coming to fruition, so they have to do something, right? Like I just picked up a huge portfolio of apartments in Chicago, and I was very surprised on that because it was so many. I'm like, where's this coming from? But they had to do it. So EV charging is mostly like if I see the apartments putting it in, it's because they're doing upgrades to their property so that people with electric cars can put in, charging stations.
Got it. It's not a mandatory thing. It's really more of a not cosmetic, but it's you're
Mandatory. No, that's not there. The only thing that's being mandatory right now is the balcony retrofit. And that is, like I said, we are very backlogged on that. We've been hiring like crazy. And now we have a lot more engineers to go out and do these inspections. They have about, 120 days to complete all the immediate and non-immediate repairs. And then 120 days or 15 days after that to start getting the reports, back to them. And like I said, if they get the permitting started 120 days prior to 2025, you're kind of in the clear there because it shows that you're making good efforts. So we have a lot of property management companies reaching out to us, getting bids, trying to figure it out because, a lot of people, I'll just get like my contractor to come and do it. That's not going to work. That's a big risk. It's better to go to a shop like ours where we can come in and do the sign off on it. When you get these handymen to do it, there's no sign off for them. So I encourage everyone that has multifamily clients, borrowers to just get the pre-assessments done for the 721.
Do it now.
And I'll throw into the chat once my computer is back up. I'm having technical difficulties. I'll send some information out to everyone on all the balcony information.
Yeah, why don't we, it'd probably be logical to have you send that to Arnie and Arnie can distribute to the distribution list. That'll spare you from panicking if your phone doesn't work.
The chat, it's fine.
We'll get her all squared away. So one of my alter egos is I'm the president of NAIOP SoCal, and there's a lot of legislation. This year is an amazingly important year for commercial real estate, this November election. There are a lot of bills that are coming in. You have Renters for Justice that's taking place. You have the Taxpayer Protection Act. You have ACA 10. You've got the lawsuit that Newsom is filing against the TPA that's supposed to be decided on tomorrow, whether it'll be pulled from the ballot or not. Are any of you impacted by this? Any of you throwing that into your underwriting that there might be more rent control, that there might be moratoriums on eviction? How is that coloring your underwriting? Gina, why don't I start with you? Only because I've usually ended with you on these, but let's see is legislation entering the discussion at all right now?
Not really. I think the biggest thing right now is the SB 721. That's kind of where the focus is. We're not getting a lot. We've already had some that have been under rent control. And so by the time they're coming to us now, we're really just taking it at face value. I am getting a lot of brokers saying, well, but look, market value is this, and we can get so much more after they acquire the property. And the theory always is, well, if they could, they would. It would be in place now.
Right.
So to answer your question, we're not seeing a lot of that yet, although Provident likes to get ahead of things. So we tend to be, the first one to be more conservative, which is always fun. So if there's going to be a shift, I'm sure we're going to feel it soon. But I think the playing field's still just leveling out of what's coming and what's possibly going to go through. And right.
And that's SB 721 again, just for clarification, that's our balcony that we're talking about earlier.
Yes.
Right. So I just want to make sure we're not talking acronyms that fool anybody. Okay.
No.
Lindsay, any differential on that?
Not too much yet, to be honest. But I like Gina, I foresee that coming our way.
Yeah.
AJ.
Yeah, the balcony stuff for sure. I mean, we've got eyes on that. I think we already play in rent controlled markets, and generally speaking, if there's going to be any shift in how lenders look at rents, there was a time, albeit it seems like eons ago, where lenders would give you credit for below market rents. Oh, I'm going to push rents. Oh, super. What are your targets going to be? Because we'll just underwrite to market. That ship has sailed. And I don't think it's just sailed in the agency world, or the bridge to agency world, or the bank world. I think that pending rent control is going to further impact what we're seeing. And I mean, fingers crossed, legs crossed, arms crossed that we don't get another eviction moratorium, because that literally dropped a bomb on San Francisco, Oakland, and LA. And the guys that suffered, you had some big guys who got in a little bit of trouble, but really the medium to the mom and pop multifamily owner, they absolutely got hit like a train. So, I mean, when I'm going to church, saying my rosary, lighting candles, doing what I do, man, I am praying against another moratorium, because we don't need it.
I think you're supposed to burn sage. I could be wrong.
I'll add that to my repertoire.
Add that to your repertoire. My favorite rent eviction one was New York City saying you can't kick people out during COVID, and people stayed in the Hamptons at $10,000 a week instead of $30,000 a week because, hey, you can't evict me. So they lived in luxury through all that at reduced rents. Linda, I think your point's well taken in the chat box, and I did see about opening it up for Q&A. We'll do that here in a couple seconds. But the ULA, or the mansion tax, up in Los Angeles has dropped transaction volume by 70%. Do I think it's going away? No, because was $215 million of free money that they didn't have before. But I think the cause and effect of ULA has been dramatic. Santa Ana, per Linda's point in the chat box, has been redlined from a lot of investors who basically just said, you know what, if I can't own my real estate and do what I want with my real estate, raise rents to market, be able to add EV stations without coming out of pocket, I'm just not going to do it. So you're starting to see people leaving those areas more than coming into them. And you're starting to see some dramatic impact. So one of the things, I wrote an article on LinkedIn, if you're interested in checking out, I call it "Apathy is Costing the Commercial Real Estate Industry Billions," because we're not getting involved in talking with our politicians. We're not voicing our objections or our fors or against various things. As a quick example, NAIOP produced a bill with Representative Quirk Silva that passed the assembly, passed every committee on an undefeated vote. And it basically was, after 30 days, a city, you're allowed to pay for another consultant to approve your permits in a city. It went to the Senate bill. The SEIU union came in and said, we're against that, and basically forced the politician to drop it. You won't see it on the ballot now. It basically died on the Senate floor from very vocal opponents saying no to that. So we need to be more vocal. So go check out that article just to see where I think things are, just because I can't help myself. But at this point, given the time we have remaining and the fact that I'm out of all my questions, let's go ahead and take the mutes off. And if there's anybody that would like to ask a question, like Mark Skolnick, let's go ahead, Mark. Let's ask that question out loud. And vacancy control is enacted. How will that affect lending? And I'm looking to my three to see who makes the first gesture. Oh, Gina rubbed her face. That means she's ready to answer the question.
Sorry, Gene.
So Gina.
It depends on, it's kind of a moving target. It depends on where and how they set that. I mean, right now, there's an industry standard on that, but I honestly, I can't begin to answer. I'd love to hear what AJ and Lindsay have on that. Let's put them on the spot first.
Fantastic. Lindsay smiled at you.
I mean, it'll be interesting, right? I was at an event a week or so ago and they were talking about this and, not being able to take a unit up to market once it's vacated. I mean, it's going to have big effects on especially the properties that haven't been keeping up with the rent increases. I feel like I've seen a couple purchase requests recently with, rents very, very below market. And, I think the clients have been shocked about, what the loans on those types of properties look like and have kind of showed them, hey, here's where I'm at, where the property is now. If this property was at or closer to market rents, here's where I'd be. And it's, substantial, a substantial impact. So for some of those properties who have lagged on keeping up with the kind of annual or the allowed rent increases, I think it'll be difficult to get them back up to market.
Well, and it's to AJ's point, I'm not going to lend it to you on a promise. You as a manager have not proven that you're willing to take it to market. So I know I have a house that I rent out and I'm below market, but I just want to keep a tenant there. They've been there, they've been loyal, they've been paying their rent. So I've just kind of left it at the rent, and now it's probably a good grand or two more. But if there's rent control saying I can only go up 3%, I'm not going to get to that market rent on them until they leave. So, right,
Well,
AJ, isn't that what you're saying? Go ahead, Gina.
I was just going to say, doesn't that essentially change market rent? If, the whole thing is just, there's so much apathy, and I'm not against, or not apathy, but empathy, really, right, going on in the world right now. And I'm not against that, but we're just ruining it for any sort of investor. I mean, especially if people are saying, no, I won't even go to Santa Ana. I mean, how many cities? Yeah, sorry.
Yeah, well, and I think that is the point. And I part of what I've said in the past was legislation is put in place with really good intent with the empathy, but the cause and effect and the steps 2, 3, and 4 that follow on behind that are problematic for our capitalist society. Not so much for a socialist society, but for a capitalist society, it's problematic. AJ, go ahead.
Yeah,
I saw you about to speak.
It's the law of unintended consequences.
Mhm.
And a classic example of this. I love San Francisco. It's awesome. I could go to the Mission, eat and drink my way through it, get blotto, take an Uber home, and absolutely have enjoyed my day. But I would be 100% lying to you if I told you that it was not an economic war zone right now. You're not going to get mobbed by a bunch of fentanyl wielding homeless zombie guys who are going to stab you to death. That's not going to happen. But here's what is going to happen. At the end of the pandemic, when it was measurably over, an emergency eviction moratorium was put in place. Now, you had folks who spent a year and a half living rent free. Now, this is a very small percentage of the folks who were impacted by COVID. And yes, they were very, very bad actors. But I'm going to give you for instance, it's having a very real world impact on a very real human being that I do business with. This guy's a champion. He's been doing business in San Francisco. His family has since the 50s. It's a great building. It's right off of Turk. It's gorgeous. I absolutely love it. It's beautiful, and I want to finance it for him. It's June 2024. You would think he'd be done with the impact of COVID by now. I mean, the extended eviction moratorium burned off almost a year ago, right? Nope. 10 evictions happening in a building, and every single one of them is going to the legal process. He's hosed.
Yeah.
His asset, he hit a maturity. He is 100% done. Now, that's just one example. Another where you want to limit the ability to roll the rent control, and this is a big one for me, that vacancy control deal. I can 100% appreciate the fact that you don't want to drop sticker shock on somebody who just wants a place to live. That makes sense. What doesn't make sense is when you dig into the markets that really have just been underperforming for a very long period of time, and you have sponsors, intelligent property owners that just want to get their assets up to code. They need rents to do that. And if you're getting $1.15 a square foot and you need to put in a new panel, If you need to replace all your balconies, if you need to get a seismic retrofit, and these are folks who have great relationships with their tenants and want to keep them all in there, these aren't people who can just, look for $500,000 in pocket change to get their assets up to code. So
Yeah.
there has to be a real world solution. And the sad part is that the folks who are authoring the legislation right now do not bother to listen to those voices when they
Right.
do it.
Right. Well, the alarming stat I was aware of was that 60 to 80% of our politicians in California, depending upon how you count, have never held a private sector job. They've only been public sector jobs. And so they've either been handed the money to spend or they go get a grant to spend it. They just haven't had to earn it. And we're having to earn it to do all these things you're talking about. But that tees up Mark Skolnick's question that he asked and saying, okay, anybody here on our panel, do you accept PACE financing? Especially for curing that SB 721. I saw a grin, AJ, so you get to answer that one first. Gina's gonna stand like a statue now, so I don't call on her with the facial action.
The downside of PACE is the subordination question. It's the big one.
Okay.
Fannie Mae and Freddie Mac do not like subordinate debt. They just don't, at least on the assets that are going to benefit most from PACE programs, or that $1 million to $9 million, $10 million asset. And the fact is the subordination is just, it's something that the agencies can't get their head around on smaller leverage or on smaller balance transactions. I think banks are absolutely kicking my teeth in there. So with that, I'm going to punt to Gina.
I think just like with any second behind us, if we're going to run into a debt cover problem, we're still, at the end of the day, it's the cash flow. There's the property cash flow for additional financing, primary financing, cash out, like AJ talked about earlier. If they need these retrofits, if they need these improvements to the property, but rates have now doubled or tripled what they were the last time they refinanced, and the rents haven't been able to go up, we're just still running into the exact same problem that the property now in today's market, if rates don't soften and all of these rules go into place, I can't raise my rent, I can't, kick people out, where am I going to get the money? So I'm going to have to walk away. I'm going to have to default. We're going to see another implosion, that's going to have to shake up the market. So the politicians actually listen to the investors and the hardworking small business guys that are just trying to, I'm just kind of vomiting here, but got a lot of emotion on all of this shift, right?
Yeah, the world's ending. Thank you, Gina. No, I'm just kidding. So, but what you said though is okay, so you've got a loan for 50% loan to value.
Right.
PACE wants to come in and add 10% to that. Well, no, let's just say you're at 70. All right, just let's get a high number. And PACE wants to put another 10% on there. Are you more worried? Wouldn't you be okay if that PACE lender is kind of stronger or more financially viable? Wouldn't you rather have them kind of as your secondary borrower? So if they default on something, you got at least somebody in the second spot to go out. That's a financial institution. No, that doesn't play in.
Well said, Eric, and absolutely. I mean, we love seller seconds. We love secondary financing. We have no issues with that. The problem is that 70% loan to value. Where's my debt cover? Am I now at a 0.90 with my first and their second? And that's the problem. We're not doing a break even between the net operating income and the annual payments on now
Right.
two loans.
Right.
So if it's a true 70% and our combined debt coverage ratio is, 1.1 or maybe even 1.05, where we're not quite break even, then we're good. But 70 LTV is irrelevant today. It doesn't come into play, at least in my world with office and multifamily. I mean, people come in all day long and they'll say, well, I got a borrower that wants 70% LTV. Why can't you do that? I mean, so-and-so bank is saying they will. And I said, well, did you ask them what their debt coverage ratio is? Because they might be just trying to pull you off the street. And if you don't understand the debt coverage ratio, right, hook, line, and sinker. So yeah, I mean, by the time I'm hitting, and AJ and Lindsay, maybe you can talk to this, by the time you hit your debt coverage ratio, when's the last time either one of you have seen 70% loan to value or 75% for that matter?
It's been about a year.
Okay.
And it's been about a year, and it was a unicorn of a deal. It really was. I mean, I see one or two a year where it's that 70-120, and usually what I'm looking at is an asset that recently had its rents popped and had been operating at like a really, really low margin for a very long time, usually an experienced sponsor.
Yeah.
Generally speaking, I at a 65-120, I'd say is about that's the most common.
Yeah. Lindsay?
Yeah, I was gonna say historically, the best I would really see would be maybe a 65, 120. Now it's even less than that.
Yep.
As far as the
Okay.
leverage, yeah.
Okay.
Okay. All right. So that was lovely.
You like how I took your question and just
I thought it was
I went a
no,
whole
that was
different way with it.
fantastic. I love it. Spin away, baby. Spin away. That is all good. A reminder, if anybody has any questions, either chat box or go ahead and shout it out. Are we seeing anybody trying to do break even on an acquisition these days? Because I remember at one point, I've been in the business 35 years, and back in 1990, you bought an apartment building at break even cash flow, banking on the appreciation, and you were able to pull that off. Anybody playing that game right now? And as for one, and then two, are you getting beat out by seller financing? Because I'm understanding that maybe seller financing is actually how you can do a deal these days at a little bit more aggressive scenario. Lindsay, you're frozen, so I'm going with you.
I would say as far as the break even, I mean, I don't know if we have any bridge lenders on here, but maybe in the bridge kind of space or definitely not in my space. I have seen some, as far as the seller financing, I have seen some requests for deals that maybe were purchased in the last couple of years that are looking to pay off seller financing. So probably have to be careful on the term of those and making sure you're going to be able to take them out.
Yeah, and so I'm going to add one real quick one to this, and it's going to be a propster for propster. But basically, we had a building sell with lender financing, and the person doing the due diligence, the buyer, buying this property, since it was seller financing, did not go get a phase one because it was not required by the lender, which is a lot of times where you're seeing things. And when they went to go get it refinanced 3 years after the seller financing wound down and the lender required a phase one as part of their due diligence, there was a $2 million environmental problem that you now get to try and go figure out what you're going to do with. So RC, is that your favorite day or your least favorite day?
I feel bad for the owner of the property at that point. I see that happen often, on these hard money loans or these seller loans. And I always try to encourage the borrowers, like, look, at the bare minimum, if you're not going to get a phase one, because maybe they're like, it's an apartment. There's no problems here. It's just an apartment. That doesn't mean it's always been an apartment. It means, especially, and I always tell everyone, if you're on a busy street or a non-residential area where there's a lot of commercial, historically there could have been a gas station there could have been an automotive repair there could have been a little shopping center there with a dry cleaner, right? And that's what we're finding when we do our due diligence on these refis, which unfortunately, once you buy the land, you own that contamination. So I get a lot of call-ins of, well, they're giving us their phase one. Well, we also don't encourage that either. They may have got their phase one from who knows what company, right? But maybe at the time, the phase one, and even Eric to that, maybe they got a phase two. Maybe they have a previous phase two, but the phase two was done in, 1998 or maybe, even 2007. But today, that phase two is not good anymore because the regulations change. So the EPA changes the levels of contamination that's allowable, right? So now we have to do vapor intrusion that was included in 2013. And now we have PFAS, which is another.
That's what I was going to hit. Hit me up. Tell us what that is real quick, because that's the new nightmare.
Yeah, so PFAS is it's in everything, right? But now the EPA wants us to do recommendations on PFAS, which you're going to find in a lot of industrial buildings. You're not going to really find it in the multifamily, and it's not really going to hit the multifamily too much unless you had some type of industrial site historically. And now, PFAS was never tested. So you're going to get that recommendation, and PFAS costs a lot of money to clean up. And we're still trying to figure out.
What is a PFAS? Tell me what a PFAS is.
Well, I wasn't ready for that question because I'm not Jenny.
You're
I
not
don't
the
have.
engineer. Yeah, okay, I'll answer it for you because I do know the question. So PFAS was basically a chemical it's called a forever chemical, and it was used in waterproofing. So if you had a piece of clothing that you could take out in the rain, an umbrella, fire retardants,
Yeah.
fire extinguishers, things of that nature with the foam there, anything that was kind of a water repellent is now discovered to be toxic at certain levels, and it's a forever chemical, and so they're now going after that. So you may not see it in large volumes in residential because that wasn't necessarily a manufacturing, but
Yeah.
you're going to see it in the water potentially because it's been around everywhere. I don't think they're worried about airborne, but definitely in the soils. So this is a new one. And I think,
Yeah.
RC, you'll validate this one for me, but your letter of, what's the letter called? Your closure letter, what is it? No further action letter?
For no further action.
Is
You might not
meaningless.
anymore.
It's meaningless.
Yeah.
You may think you're done, but it's actually meaningless because standards have changed and you don't have PFAS. Is that correct too now?
Yeah, that's what happens with a lot of these old phase twos that everyone's like, well, we're in the clear. They did a phase two. It's clear. It's not. And never trust it. Encourage your borrowers to get their own due diligence if they're not going to go through the traditional lending, right? And even let's just say on like AJ small loan deals for agency, we don't do full phase ones for those properties. We do environmental transaction screen. So sometimes even then it can be missed because we're not necessarily going into the agencies and getting full environmental due diligence. We do a lot more than we used to for the environmental due diligence for agency, but for small loan, but not as much as a full phase one. You don't get the innocent landowner's defense. So it is important to know what type of property you're dealing with, and historically, not just, or it was vacant land. Okay.
Yeah.
Landfill there.
Exactly.
Right.
Gina,
Yeah.
I saw you about to cry. Was that because you just had a horror story that you're dealing with? Because I saw you kind of going, oh my God, you just reminded me.
Well, no, I think it's more just, the fact that you're hearing about the PFOS, right? I've been hearing about it. I've been reading about it. And the fact that it's a forever chemical, my brain's just like, well, if it's forever, how do we remove it? How do we actually solve this? And the costs involved. And like RC was saying about, the phase ones and these buyers that are using seller financing and not knowing that the PFOs or it's like today's version of asbestos, right? In a way, it's just more messes for our poor investors that, outside of the slum lords, most investors are just trying to, run a good property, make a profit, and not have more headaches. And
exactly.
Not making it easy.
I agree. All right, we have a few minutes left. So AJ, go ahead. I know you wanted to tag on to what was said before, but tag on to that and then give us your final thoughts of the day, and I'll work my way back through and we'll get yanked out at 10. So you got a minute.
All right, a minute. Here we go. If you've got somebody who's going in with a private money loan or seller financing and they don't want to spring for a phase one because they're cheap or it's not required or whatever, at least hit up GeoTracker and take a look at the number of open environmental concerns around your asset. If that doesn't convince the sponsor to go into their pocket and pay for a phase one, nothing will. If you're in California and you don't know what GeoTracker is and you're investing with hard money, you need to.
Yep.
And that's pretty much all I've got.
All right. Give us your 2 seconds on one last thing from you. Call me for this, call me for that, and then we're gonna go Gina, Lindsay, RC.
Perfect.
You
If you want to
10-second pitch.
Awesome. Multifamily nationwide, rates ranging from the middle 5s to the low 6s. million, the minimum loan amount. There really isn't a maximum. If you want to know that if you've got a dog that hunts, give me a call. We can talk for 15 minutes over the phone. I'll let you know where you're going to be with rate, term, pricing, etc.
Perfect. Thank you, Gina.
Yeah, Provident Bank, again, multifamily is our favorite, a little bit of mixed use. We're 350,000 loan amount up to about 4 or 5 million. And we're local decisions, long time, 65-year bank. And I've been here a long time, so I'm staying put. I'm here to help.
Fantastic. Fantastic. Thank you. Lindsay.
Lindsay Spute with Everbank, and we are focused on multifamily as well. Loan amounts between 1 to 25 million, and we're active in the major metro markets of California, Florida, Washington, and Oregon. So let me know if I could be a resource to you on your multifamily deals.
Fantastic. RC.
RC Propster, Partner Engineering and Science. Give me a call if you're just curious about what's happening in your deal. I can take a look at the property and tell you what you should be ordering. Phase 1, PCA, Alta, zoning. We do it all.
Fantastic. And in the last 15 seconds, I'm Eric Paulson with Kidder Matthews. I'm the regional president responsible for Southern California and Arizona. If you have any questions about your real estate, I provide property management, appraisal, and commercial brokerage services. Thank you very much for being part of our group. I'll be like the radio DJ. The music ends now.